Good morning. It's Thursday, the 21st of March, and this is Govindraj Ethiraj broadcasting from Mumbai, India's distinctly warmer financial capital. As I begin, a big thank you from the entire Core Report team for all your feedback, encouragement, love, which has kept us going all this while for the 250th episode, which is today. So thank you once again. And now our top stories and themes for the day. Global investors are now promising that funds will flow after the general elections. Buying gold gets tough as governments, including yours, push up prices. India's Billionaire Raj more unequal than the British Raj, the Inequality Lab reports. The big IT industry shifts that will determine trends for 2024. And median reservoir levels hide distress in southern states.
This is a Core Report with Govindraj Ethiraj.
Global investors promise fund flows will increase after election results are out. So equity markets were volatile once again on Wednesday ahead of a US Federal Reserve decision on interest rates. The expectation overnight was of interest rates holding higher for longer. Speculation as to whether the Federal Reserve would lower interest rates has been keeping global markets on the edge for months now. More at some points compared to others, including in India right now, when domestic triggers have somewhat faded. Indian equities are close to 5-week lows and the indices have been swinging wildly, a trend usually seen when markets are waiting once again for major triggers. As we've been discussing, there are actually no known market-wide triggers on the horizon till India's general election results, which are out in the first week of June. Speaking of triggers, JP Chase analysts predicted yesterday there would be more foreign inflows after the general elections. Presumably, they mean the results. According to them, global funds would use corrections in the Indian market to increase holdings, which in some ways is already reflected in the high foreign institutional investor inflows in the month of March. The JP analyst said that rising investor interest in India is forming a virtuous cycle of liquidity, sell-side coverage, investor participation, and capital issuance, according to a Bloomberg report. According to him, if all benchmarked investors, that's emerging markets, Asia ex-Japan, global ex-US, and global, simply close their underweight positions on India, this could lead to $100 billion in inflows over the next few years. Meanwhile, back to the present, and yesterday, the BSE Sensex swung 728 points intraday before closing 90 points higher at 72,102, while the Nifty50 closed up at 21,839, up 22 points. The top gainers of the Sensex were Maruti Suzuki, Nestle, Reliance Industries, and Bajaj Finance. The BSE mid-cap and small-cap indices, the focus of everyone's attention, were mostly steady. The rupee was weak, though, closing at a one-month low against the dollar on Wednesday ahead of a release of the US Federal Open Market Committee's meeting, or the interest rate announcement that we've been referring to, and we will come to more of that in a moment. The rupee lost 13 paise to close at 83 rupees 17 paise against the US dollar. Oil prices also fell on Wednesday after hitting multi-month highs for the same reason, which is investors looking out for the Federal Reserve's announcement, and the additional point being US crude inventory data. Brent is still high, though it edged lower to trade at about $86 a barrel after its highest close since late October. Reserve Bank of India talks stock market froth too. Yes, I know it sounds like a coffee shop now. But as we discussed on the Core Report, both regulators, the Securities and Exchange Board of India and the Reserve Bank of India, have almost been jointly and in sync responding to the overall exuberance in borrowing as well as stock market investments. And it does appear that there is a link between the two. I don't mean the regulators, because that there surely is, but I mean between borrowing by people and then putting that money into stock markets. The Reserve Bank has said in its monthly bulletin that stocks are riding an intense bull market, notwithstanding intermittent corrections driven by a broad-based boom. While large caps are gaining, mid and small caps are rising even faster, with hints of froth and a spreading equity culture, according to the report quoted by Money Control. The Reserve Bank of India is a monthly publication focused on developments in domestic and global economies and does not or is not supposed to represent the views of the central bank. The bulletin also pointed out that foreign portfolio investment holdings in Indian equities have fallen to decadal lows at about 16%, reflecting also greater holding by domestic investors, a fact that we've been pointing out. This, of course, is both directly and via mutual funds. So the regulators are now calling out the froth in the market whenever they can and to whoever they can. The comments and actions like asking mutual funds investing in small caps and mid caps to run stress tests on their funds has had the desired reaction. Mid caps and small cap stocks have been sinking since late February but seem somewhat steadied now, even as several analysts now are calling for focused and specific investments in specific stocks which are in better shape or likely in better shape. So here's a data point that you may not have known. In 2023, mid-cap funds saw inflows of 22,900 crores and small-cap schemes about 41,000 crore rupees. On the other hand, large-cap schemes, which mostly invest in the big stocks that we know that are in the Sensex and some extent the Nifty50, saw outflows of about 3,000 crores according to Money Control. Gold prices are high because the governments are shopping too. People in India buy gold for many reasons, ranging from savings, of course, to festive occasions like Diwali and, of course, weddings. Now, that would be the normal reason for gold prices to rise, but this year is different. And this is also why we're returning to gold within a day to dive deeper into what's happening, or at least try and understand what's happening, because it is important. Central banks world over are buying more gold to shore up their gold reserves, pushing up prices to record highs. India is no exception, as we will find out. Imports of physical gold are also rising. And from all accounts, some of it is unusual, as we said, and linked to more geopolitical reasons than financial or market reasons. So I reached out to Jigar Pandit, head of commodity and currency business at Sharekhan by BNP Paribas, and I began by asking him what were the forces of demand and supply that he was seeing in gold prices, before also asking him for his outlook and strategy, particularly when it comes to investing in sovereign gold bonds.
We believe there are four major reasons why the gold prices is moving in the international market. To begin with, of course, the Fed interest rate. Second is the geopolitical tension. Third is the central bank buying. Of course, fourth is, if you see last couple of years, the funds have not been allocated to a larger extent in gold. Majorly, we believe that the funds have majorly gone to more of a risky assets, including the Bitcoin and so on and so forth. But now again, the funds have gold because of the prices moving up, central banks showing interest, geopolitical tensions. That is, creating that interest for funds coming back to the gold as an investment for a longer term. So these four reasons we believe is definitely pushing the gold price towards on the northern direction.
And you said that central banks are buying. So would that be a factor that's different from previous buying rounds or previous occasions where prices have gone up? At least the level at which central banks are buying?
If you see in last 2022, the highest purchase of last 10 to 12 years was highest purchase in 2022, which clearly indicates that central banks are showing a constant interest in accumulating and holding for a longer term, even at this price also. And the major reason what we foresee is because of the geopolitical tensions. They do not have right now the larger confidence, and that may, can create a safe haven investment buying. That is the reason, the central banks are continuously buying.
So which are the banks that are prominent buyers right now, Jigar? Or which countries?
So we believe China, Turkey, Russia, Poland, India, these are the few, who are buying continuously from last couple of years.
And has that increased in the last few months? Because this is the point at which we've also seen prices hitting record highs.
Yeah. So if you see in February, RBI has added around 4.7 ton of gold, taking our gold reserves to an all-time high of around 817 tons rather. And we believe that is the case with most of the central banks, that the purchasers definitely shoot up their gold reserves to a all-time high.
Right. And is that the reason why imports of gold are also going up? I mean, is that what that number is reflecting when we see $6.1 billion of gold imports in February?
Yeah. So 4.7 ton is a very, very large quantity in a way for RBI to, import. So I think one of the reasons imports is going up is, of course, the RBI. And secondly, one reason which I have, missed in terms of adding on the gold price going up is the overall, we see the crude oil prices are likely, right now it's booming up. It's going up. So gold has always been hedged against the inflation. And when the crude oil prices goes up, generally the inflation goes up. So that is also one of the reasons we are seeing a lot of buying interest in gold.
We are also seeing redemptions now of sovereign gold bonds, which were bought in 2015. And that was an 8-year bond, I think. Any insights on that? Because that will also help people maybe get a sense on how they should be looking or approaching investments in sovereign gold bonds.
As a broking house, we have always recommended buying sovereign gold fund for a very long-term investment, and especially the clients who are holding the ETFs. We generally advise them to switch their holding from gold ETF to sovereign gold bond for a very simple reason is that they get the annualized interest of 2.5%, and they do not need to pay any AMC charges, which generally AMC companies charges for holding for a longer period. So if hypothetically, I'll just give you some numbers. Hypothetically, if the AMC is charging 0.75 as a monthly yearly charges, so for 5 years, if someone is holding, that comes to around 3.75%. And for 5 years, the interest which client is going to earn on the SGB is around 2.5% yearly. So effectively, it becomes for 5 years, it becomes 12.50. So 12.50 plus 3.75, which is around 16.5% is what client is going to save in 5 years on just holding the gold. So that is the reason why we advise our clients to switch from ETF to sovereign gold bond.
2015 edition of the sovereign gold bonds. So the gap is quite high. It's almost doubled, I think, between what must have been issued at that point and those who are redeeming today. I mean, obviously, I'm sure the Reserve Bank has enough funds to do so, but is it a large amount? Is it affecting anything else in the market?
The major factors which are impacting the gold prices. So first of all, we'll have to understand we are a price taker and we are not a price giver, or we are not a price dictator in context to the gold price. The SGB redemption will not have a very, very large impact on moving the prices either upward or northward. The reason why the prices move is majorly, of course, the international news which is impacting the gold prices. For a very shorter period or for more of a sentiment perspective, it may impact for a shorter period of time, but that will not prevail for a longer term. In terms of when you are asking a question about redemption is impacting prices, my answer would say not to a very, very large extent.
Let's say, what would the government be spending or the bank be spending in the gap between what it would have issued the bonds at in 2015 and today when people are redeeming it?
Well, honestly speaking, I will not have the precise number, but by and large, to what I understand was in 2015, I think the first series was around 2,800 rupees versus the current price of say 6,000. So that is the by and large the difference. So per gram, it is 3,200 rupees is the difference.
Right. What's your outlook in coming months? How are you seeing prices move, or even for that matter, demand supply move?
When the outlook is concerned, we believe that the inflation numbers are not improving, then US Fed will not be aggressive in cutting the interest rate. So market is expecting that at least 3 cut will definitely impact the price. But if 2 price cut till June will not have a larger impact. And looking at the current numbers, we believe they will not be so aggressive in cutting the interest rate. And hence, we believe the prices may little go down till say around $2,080, $2,100. But by and large, for a 1 year horizon, we believe prices will definitely touch $2,400, $2,450. And for a shorter term, we believe prices will cross $2,200.
Right. That's useful and helpful. Jigar, thank you so much for joining me.
Thank you very much for inviting me, Govind.
Inequality in India rises to highest in a century. The wealth concentrated in the richest 1% of India's population is at its highest in 6 decades, and the percentage share of income exceeds that of countries including Brazil and the United States. Research group the World Inequality Lab has said. The billionaire Raj, headed by India's modern bourgeoisie, is now more unequal than the British Raj, headed by the colonialist forces, the authors have said. By the end of 2023, India's richest citizens owned about 40% of the country's wealth, which is the highest since 1961. And their share of total income was about 23%, the most since 1922. The study, whose 4 authors included Nitin Kumar Bharti and Thomas Piketty, said. Now, Thomas Piketty is a French economist and author of several books, including the famous Capital in the 21st Century, that focuses on wealth and income inequality in Europe and the United States since the 18th century. This study, titled Income and Wealth Inequality in India 1992 to 2023, The Rise of the Billionaire Raj, states that wealth inequality, quite simply, is near its historic highs. It also notes that wealth, which can broadly be a measure of assets held as opposed to income earned, is unequally distributed. 1992 is the year liberalization is seen to have kicked off in India. The big shifts in Indian IT. India's domestic IT overtakes global exports in growth. India's information technology services industry was projected to stand at about $354 billion at the end of this financial year or at the end of this month. That projection was made by Nasscom, or the National Association of Software and Services Companies, last month. India's IT industry is at a turning point of sorts. While there have been many technology upheavals in the last few decades, with each round sounding more menacing than the previous one, the advent of artificial intelligence and artificial intelligence-linked tools has clearly brought in a new dimension, that is, jobs. There is no doubt that the number of jobs are not growing as fast as before, though the industry still employs around 5.4 million people and is quite likely to start shrinking. On the other hand, global capability centers, which are India technology outposts for mostly large Western multinationals, are growing in shape, size, and form, and also employing more people. India is home to about 1,600 GCCs, as they are called, with a total market size of about $46 billion and growing at about 11%, according to a Nasscom report. Dilip Kumar Khandelwal, Deutsche Bank's global head of technology centers and CEO of Deutsche India, told the Business Standard, "Our centers in India are so much more than talent hubs. They're an integral part of the bank focused on delivering value to our clients. And over the years, Deutsche India has grown markedly with more than 18,000 employees across multiple functions." Now, there are several, and I do mean several, companies with very, very large employee base, but serving their global parents or multinational parents, mostly in the Western world. But the interesting twist is this. India's software industry is now actually growing faster than exports. It's a big shift from the past, when it was exports always leading domestic and by far. Nasscom chairman Rajesh Nambiar, and also chairman of IT services company Cognizant, said last month that for the first time, domestic IT growth in 2023 exceeded exports. Domestic growth was supported by government investments and embracement of emerging technologies as the market grew about 8%, he said, in 2023. So, will the industry hold its target for 2023-24? And what are the major trends that mark the year that has gone or is going by, and will also define the near future, both internal and external? I reached out to Sangeeta Gupta, Chief Strategy Officer and Senior VP at Nasscom, and I began by asking her if the industry's projections for this year were on track.
The IT industry, as per Nasscom, latest projections that we put out, is expected to touch 254 billion at the end of March 2024. So this is almost 90% of that business is already underway. So yes, we are very hopeful that this will get done. Also, I just want to clarify that this is not exports. This also includes the India market part of, yes, it will be about 200 billion plus is exports, and the rest is the India market.
You had earlier projected about 8.4%, and this 254, which includes international and domestic, low is about 3.8%. So obviously the international market has slowed down, but has the India market slowed down as well?
Global market witnessed a tremendous slowdown because of all the macroeconomic issues that the world is going through. However, I think India was a much brighter star for us during the year, which the India market grew almost 2x of the global market. So it's about 6.8 to 7% growth that we've seen in the India market business. And the good part of that growth is it's very broad-based across government, enterprises, small SMB customers, etc. So yes, this was one of the very few years where the India market far outpaced the growth of the global market.
Right. And what are the trends that you're seeing within, both in terms of what companies are doing and responding, and also in terms of what the market forces are dictating at this point?
So I think from a market forces perspective, and Govind, as we look at, what lies ahead, clearly there are multiple changes or uncertainties that are still out there. The global macro environment continues to be very uncertain, but you've got to live with this uncertain environment. I think the technology shifts have seen rapid acceleration over the past year, and generative AI has taken center stage, and that means companies will need to invest and build for that. I think the third is really that while US and parts of Europe have been key markets for the industry, there's increasing need to focus on newer markets, newer opportunities, so that you expand the pool of companies and businesses that you will work with. And last is, of course, the focus on making sure that in this environment where customers are increasingly focusing on cost efficiencies, how do you become much more lean, agile as organizations to be able to address it? So how are companies thinking about it, right? One is, invest in the right solution. So invest in the technology platforms, create the partnerships and collaborations that are needed to be able to do it. Two is strengthen your sales engine, mine your existing customers better, think about what your new GTM strategies can be for your next set of customers. The large deals that are now coming in. So in the last year, we saw a huge pipeline of, deal signing that took place. But deal signing to conversion has been much slower because of client ramp ups have taken much longer. But how are you embedding not just the cost efficiencies, but increased productivity and innovation into these deals that you're taking about? I think the last priority continues to be invest in talent and skilling, because clearly what you will need to do going forward is not going to be the similar one that you did in the past.
So, this is a slightly broader question. The industry grew at a certain rate, including expanding in terms of number of people and so on, for the last maybe 25 years. Was this year, that's the last year really, was this a turning point of sorts after all these years?
Yeah, so I think this year was definitely one of our lowest years in terms of net hiring. We hired only 60,000 net new people, which is not something we've seen in a long time in this industry. However, I would not necessarily link this go into non-linearity coming into the industry at this stage. A lot of the low hiring or degrowth that happened in a few companies was a result of excessive hiring that had happened in 2021 and 2022. So in 2021 and 2022, as an industry, we hired 8 lakh new people. And hence, there was an issue of excess capacity in the industry because it was based on the assumption that digital acceleration would continue to grow at the same pace, which saw a sudden slowdown. So I think there was a lot of factor of correction that came in this year, and hence the slowdown in hiring. Going forward, of course, the focus would be to break the linearity, to show more non-linearity. But I think given India's talent capacity that exists for the world, it's very important that new business keeps coming in so that more and more hiring can take place. The same job may not require the same set of people. But if I can expand the pool of what business I'm doing, then I need more people to be able to do it.
So, could you give us an illustration of both? One is, what is that new business? And secondly, what are the new geographies that the industry could or would or should or is looking at?
Good. So I'll start with the second question first, right, Govind? I think the new business that you think about, one is, I think the India market is a great opportunity. I was, I think day before, L&T Technology Services announced a 100 million project with the Maharashtra government on cybersecurity. Now, in the past, you would not see these large scale projects from an India perspective coming in. So clearly, I think the opportunities in markets like India that we are seeing, the opportunities in markets like Germany, we are seeing more and more companies are looking at saying what more I can do in areas like continental Europe, the Nordics region, parts of Asia Pacific, but it's obviously not the same. But clearly Europe is very high on industry's agenda as well as opportunities in India. I think in terms of new businesses, it's about certain sectors that have, while they've been around for some time, they've not been as high growth sectors. So product engineering, the whole ER&D sector as we see it, I think that was responsible for almost 48% of the incremental growth in export business this year. So clearly, what more can we do from a product engineering perspective? Because clearly with AI and other technologies becoming so center stage, people are looking to re-architect their products, whether I'm a manufacturing company or I'm an auto company or I'm a medical devices company. So I would say engineering R&D is a growth focus for the industry, and you're seeing increased investments happening in that sector. I think the second is really about how AI and generative AI can actually open up opportunities for companies that would not have traditionally thought of working in India around it, right? They could have been much smaller companies for whom the whole transformation to move to a location so far away would have been very, very difficult. But AI and generative AI is actually enabling that opportunity to be able to go out and do that. So I would say, those like are illustrative examples of new opportunities that the industry stands.
The export number, that's IT export, includes both IT services companies, who we are all familiar with, and the global capability centers, or really arms of large global companies like a Walmart or a Target, sitting here and somewhat invisible to at least most people in the country. Between the two, do you see any differences in the way they're growing? And is one growing more than the other, if you were to use, let's say, last year as a start point?
Yeah, I think so. 2023 was going very much the year of GCCs, right? I think both in terms of existing GCCs expanding their operations in the country, as well as new 50 plus new GCCs entered India in the last year. What's happening in the GCC world is two things. One, because of the global focus on cost efficiencies, many new companies that had not thought of, coming to India are actually now exploring their India opportunity. So that's one big shift that's taking place. I think the second is again related back to the engineering segment. Many manufacturing companies are really saying, if I need to build my product faster, quicker, time to action, then I need to be in a market like India where I can build my technology much, much, much faster. So yes, JCCs have seen more rapid growth over the last year. Having said that, for us, I think it's not one versus the other, because at this, both side of segments have their own niches and will continue to grow. And, it's a cycle that keeps changing for different companies.
Right. Sangeeta, thank you so much for joining me.
Thank you so much, Govind.
Median reservoir levels hide distress in southern states. We touched upon reservoir levels yesterday and pointed out that storage levels were lower than the previous year. What we did not bring out is that number is still fine if averaged out over 10 years. The bigger problem is some states are really badly affected, mostly in the south of India and even to some extent the north. There are 150 reservoirs that are monitored by the Central Water Commission on a weekly basis, and the total live capacity at full reservoir level, or FRL as it's called, is about 179 billion cubic meters, or BCM. The level of live storage as of 14th March was about 40% of the live capacity. The ratio last year at this point of time was 47%. Now, while this is lower, the 10-year average was only 41%. So, therefore, is not a major cause for worry, according to research put out by the Bank of Baroda. The problem is in the south, where, for instance, reservoir levels are down from 42% to 24%. The states under pressure are Andhra Pradesh 13%, Tamil Nadu 30%, and Karnataka 26%. Remember, the average that we're talking about is about 40%. The western region was also lower by 9% in Maharashtra and Gujarat, and the northern region has seen a dip from 39 to 34, with Punjab at 49 to 36 and Rajasthan 48 to 40, seeing the sharper declines. Well, that's it from me for today. I hope you enjoyed the 250th episode as much as we have enjoyed all these 250 episodes and putting them together for you, and hope to see you tomorrow, same time, and also for the next 250. Bye for now. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.